Welcome to Tom's Spatula City exercise. We're going to be looking at the income statement today. What you see on the screen right now is the statement of assumptions. I've made some additions to this so that we can go a little bit quickly through the income statement. So first you'll see we have the name of the company as Tom's Spatula City. So if we go to the income statement, it also says Tom's Spatula City. If we go to the other, we'll talk about the loan sheet in another lecture. In the other sheets here, you'll notice that it says your company. That's because I have linked the statement of assumptions to the income statement. This linking process we're going to be using over and over again throughout this, and it's very important to get it. So we're going to do that first. As you can see, this square says Tom's Spatula City. If we go back to the statement of accounts and we change this to Dave's Spatula City, then we go back to the income statement, it's now Dave's Spatula City. But since I'm not Dave and we don't want that, we'll change it back. Notice also when we go to the balance sheet, it still says your company because that's unlinked. So we click on this sheet, we see what's in this square is your company. When we click on income statement and look at what's in this, it's equal sign, SOA, which is statement of accounts, and then exclamation B1. That tells it to go to cell B1 in the statement of accounts and get what's there and put it here. We're going to be using that feature repeatedly. After a while, I will assume you know how to do it, but we're going to go through it several times at the beginning of this lecture. Okay, so we go back to the statement of assumptions. We're going to change this back to Tom's Spatula City. All right, now Spatula City, we sell spatulas and that's all. It's a fake commercial that I heard when I was getting ready to do this, and I redid these sheets from the Brain Candy sheets so that you could see them created from scratch and to make them relevant to a retail sales type situation. So the things that we're going to need to fill out our income statement, if you remember from creating our income statement, is we need our sales, and then we need our cost of goods sold, and then we need our operating expenses, and then we'll need any interest we might be paying, and then we'll need any taxes we might be paying, and that will get us to our net income and our cumulative net income. So some of these things will be numbers on this sheet. Most will not. As a matter of fact, I'm not sure I have any numbers on this sheet at all. Sometimes it will be necessary to put in numbers, but what I like to do whenever possible is link back to another sheet so that we can change things. For instance, right now it shows gross sales of $4,800. If we go to the statement of assumptions, we're assuming gross sales, and this actually should label probably first month as $4,800. Now let's see what happens if we change that to $3,000. Then we go back here and we see that our gross sales changes to $3,000. Not only that, all future sales change. There's probably an error in this sheet because we don't keep growing, which we should. So we'll fix that in a minute. But for right now, let's go back and change this to 4,800 so we can work through it as it was designed. All right, sales growth. I'm assuming that we will grow our business 2% every month. We can change that number to 3% or 4% or 0% or negative 10%, and that change will flow throughout our entire sheet. I'm assuming about 8% of our items will be returned. I'm further assuming that when those items are returned, we will throw them away. I'm assuming a beginning inventory of $1,200 worth of spatulas, and that we will make a specific number of purchases made based on our gross sales. and that is 12.5% of our gross sales we will put into additional purchases. I'm also assuming that our cost of goods sold is 25% of our gross sales. So what I'm assuming is that for everything we sell, we mark it up 4 times. So if we buy a spatula for $1, we sell it for $4. If we buy one for $5, we sell it for $20. I also have a set of operating expenses over here for advertising, insurance, rent, telephone, and utilities. Now, if we have different operating expenses or other operating expenses, you could put those in here as well. If we just want to carry over our total operating expenses, we could have a total line here, and we could just carry the total over here, and we would just have a total expenses line. But that doesn't make a lot of sense. People are going to want to see a breakout of that. Now, interest expense, this is a little tricky. And you'll notice that the numbers here kind of go down as we go. That's because there's a loan. We assumed, if we go to the statement of accounts, we assumed a $5,000 loan, and we assumed a 10%. Actually, I don't think I used this number at all. Let's see what happens if we delete it. If we go back to the income statement, nothing happens, and I'll show you why in a minute. But anyway, we borrowed $5,000. We also assumed a tax rate of 18%. That is, the business is paying a tax of 18% on its profits. So briefly, let's go into the loan. There's a whole thing, I think it's like 15 minutes long, about the loan and generating this sheet. But in general, what we did is we had a starting balance of $5,000. We assumed 0.00833, which is about a 10%. I think this was a 10% interest rate. If we click on this, we see it's 10% divided by 12 because we charge interest rate monthly. And then we assumed a payment of $100 a month. So the first month we had $5,000 that we owed. We charged interest on that of $41.66, which led to a loan amount of $5,041.66, made a $100 payment, and that left us owing $49.41. Now $49.41 in month 2, more interest, made us owe $49.82, and then we paid $100 and it goes down. We generated this entire amortization schedule. There we go. Escape. We generated this whole sheet was generated so that we could get our interest expense on our income statement. So if we look at our income statement, it references loan C5, and then this one will represent loan D5. I keep doing that. Undo, escape. Okay, and then this is, if we click on it, is loan E5, and so on and so forth. So it refers back to this. Now this is the cleanest way to do this. We could make a really complicated calculation so that we could show everything on the statement of assumptions in a single column, but it's much easier to let Excel do the heavy lifting and do it that way. Okay, now some problems that you might have as you create this. Let's walk through the income statement. First, for sales, we have our gross sales at 4,800. So that number is directly from the other statement. Now, the number in month 2 is the previous month plus the previous month times the rate of increase, which is in B6. So if we go over here, escape out, and go to B6 on statement of accounts, B6 says our sales growth will be 2%. Now, if you notice, we grow the first month, and then we don't ever grow anymore. The reason for that is when we look at this month, it's going to be looking at C6 instead of, it's D7, D7, and it's looking at C6. And the problem with C6, if we go over here and look at our statement of accounts, is C6 has no value in it. So what happened is we grew one month and then we never grew again. Now to fix that, many of you know this, but for those of you who don't, we're going to go in here and we're referring to the statement of accounts, and we're going to fix the $ here, and that will keep us in B6. Now let's see what happens when we drag that over. Notice the numbers go up. They go 4086, 4993, 5093, and so on and so forth. Now we need to carry that increase all the way through. And what you'll notice is that increase will end up carrying through this entire sheet. So if we come down here and we look at our net income all the way through, so we start in January of 2016, so January 2017, 2018, 2019, January 2020 would be, so January 2016, January 17, 18, 19, 20. So the end of 2020 is 4 years. At the end of 4 years, we've made $133,000 in net profit. Watch how much that number changes when we drag this and we grow 2% a year instead of remaining steady. So it was 133,000. Now it's 266,000. So just a little bit of growth is a really big deal, right? Okay. And we accomplished that growth. Well, we accomplished that growth through hard work and selling lots of spatulas. But mathematically and in Excel, we accomplished that growth by putting a $ in front of the B so that it continued to look at B6 over and over again instead of looking somewhere else. All right, so, oops, I always do that. So our sales returns are based on, let's see what we based these on. We said we'll refer to B7, and you'll see there's a $ in the B and a $ in the 7 there. So if we go to B7, we said returns are 0.083%, and we carried that through all the way. So as we sell more, we return more. By the end of this, we're selling $15,000 worth of hats or spatulas a month, and we're getting almost $1,300 of that returned. Now, obviously, as we were really in business, our returns wouldn't increase directly with the amount of sales we made. Also, many of our returns we would be able to sell. But because we're building this entire sheet and this entire set of financials based on more or less a worst case scenario, we can say, hey, everything that comes back in, we're assuming we have to throw away. So anything that we don't have to throw away and we get to keep turns out to be additional profit for us. And our net sales is simply our gross sales minus our sales returns. Our cost of goods sold, do we have a number in here? No. We have our cost of goods sold as 25% times our initial sales in statement of accounts B12. Now, in here, it's our gross sales times the rate in our statement of accounts. Did I just... Okay, I didn't mess it up, did I? No. Okay, good. All right. Now, by doing this, by creating this whole sheet this way, our gross margin then is our net sales minus our cost of goods sold. Then we subtract out our operating expenses, which again are all listed in the assumptions. And that gives us we get to our total expenses. We subtract those from our gross margin to get earnings before interest and taxes. Our interest, as I explained, we get from the loan sheet, and then we subtract that out to get our earnings before taxes. And then we have our tax rate, which is 18%. Then we have our net income and our cumulative net income. Now the balance of having all of these numbers over here is we get to test, and we'll talk about at some point in the very near future stress testing our business and using some analyses to figure out where we might have problems. One thing that could happen is our cost of goods sold could get more expensive, and we could go through and we could change each of these numbers. But let's say we find out that our cost of goods sold, instead of being 25%, is 40%. We change that here, and we go back to the income statement, and all of these numbers change. Remember, this was $266,000 down here. And by changing from 25 to 40%, if our cost of goods goes up 15%, we go from $260,000 to just under $200,000. So it's a pretty big deal. We remain profitable all the way through, even at a 40% cost of goods sold, which is pretty cool. We can. What happens if the landlord doubles our rent? Well, we just, that would be nice. We change our rent to $300. We go to the income statement. Our rent is $300 all the way across. It flows through. So this went from $650 to $800, which it should, since we went from $150 to $300 on rent. Okay, let's go back and change this to $150. Now that's the importance of linking the accounts, and that's a good general way to set up your income statement. Now you'll do the same thing on the balance sheet and the statement of cash flows. So they'll all work the same way. They'll all refer back to your statement of assumptions. And then we can just change items in one place to look at what happens to our business. That's pretty much the whole concept. What you'll notice as you put this together is in the first column, for the first month, you see you're referring specifically just to a cell, and then after that you're going to have some sort of a formula involving the previous month's cell typically. And the reason for that is there we go. See, it refers is the first month is put together one way, and then the second month is all a mathematical model of what happens after the first month. There are other things that can happen that make this a little more complicated. For instance, rent might go up on an annual basis. Now, if that were to happen, we would go up here, and then we would link this cell to rent in year 2. So we'd go to statement of accounts, and we'd say rent, and we'd make rent say goes to $200 in year 2. If we're going to do that, we might, if things are just going to go up annually, we can label this year, and then we'll make this 1, and we'll make this 2, and then instead of having this drug all the way over each time, when there's a change, we would say equals, and then we would go back to the statement of accounts, and we would go to the second year and put that in, and then edit it so that it doesn't change by putting our dollar signs in here and then dragging it over. And we can of course do that year by year for things that might change. For instance, we might spend more on advertising in year 2. Our insurance rates might predictably go up because we have more sales and more business. If we had any expense related to volume would go up from time to time. We might also have our insurance rates go down over time because we've been a good customer. And so we could make those changes all the way through here. The important thing is when you have something that can be coded into the statement of statement of assumptions, you code it back into the statement of assumptions. That way, if you want to change the number, you can change it out here as opposed to in there. Okay, that's pretty much the entire thing for the income statement. There will be questions, and that's fine. We can ask those in class. You can ask those by email, and we can go forward and help you create these. The next installment of this will be the balance sheet, and I'll build the balance sheet beforehand and go through how I built it just as I went through the statement of accounts for you. So thank you, and you guys have a great day.